Hello and welcome. You're watching Business Today Television. I am Sakshi Batra and this is a special edition where our focus is on the Q3 earnings. The company in our focus today is Happiest Minds Technologies that's announced the October to December quarterly earnings. That's Q3 of FY24, reporting a rise of 3.5% in the consolidated net profits. That's coming at 59.6 crores. The IT services company's revenues from operations for the third quarter have grown about 12% at 410 odd crore rupees. EBITDA has also seen a surge of 8.2% to 105 crore rupees as well. Now, joining in to discuss the key insights from the quarterly earnings and the outlook also going forward from here are two very special guests, the top management of the company. Venkatraman Narayanan, the MD and CFO of the company, also joins in with us is Joseph Anantharaju. He's the Executive Vice Chairman and CEO of Product Engineering. Welcome to both of you to Business Today Television. It's a pleasure to host you both. It's been panned out as a decent set of numbers for the street. However, tell me, Mr. Narayanan, if you could mention for us, how has the quarter really panned out for you? Is it as per your expectations or better on some of the accounts? You've already mentioned that it's the 15th straight quarter where you've beaten your own profit guidance.
On top line, Sakshi, I would have liked it if we could have done slightly higher, but given that it was an extremely short quarter, 3 less working days, furloughs, people taking holidays, we could have planned for it, but there are some things which, how much ever you try, you can't just cover up. We still recovered and we have shown a 0.8% growth both in rupee terms and dollar terms consistently on a sequential basis. Year over year, we have done 11.5% in constant currency, which is very close to the 12% guidance that we have given to the street. As far as profits are concerned, 15th quarter, where we have beaten the EBITDA guidance of 22 to 24%, and hope is that we'll continue to do that and perform in line with that. Coming to how we are looking, the immediate now and here is all about meeting our 12% guidance for Q4 and for the year. So there is a task that's set for us. We have to grow about 4% in quarter 4. We are hoping some of the reversals of the furloughs and the lesser working days will come to our help, and also the markets that are slowly taking a turn for the better will also help from I'm not saying tailwinds, but it will help us boost our performance for the next quarter.
Fair enough, sir. I will be using these two of the cues from your answer to ask you the next two questions. One is on the furloughs that you actually saw in Q3. Are we done with the seasonality factor, or do you think some more furloughs impact and seasonality impact will also come in Q4 as well? That's one part of the question. Second of all, overall demand scenario, how do you really look at that going forward from here? Since you said things are turning for the better, how do you see the key markets of yours really recovering from the pain that we have been seeing over the last 3 years, 3 quarters?
Sure. So if you look at the furloughs, I think the furloughs were a little deeper than usual, maybe a week more than what we typically would see, and that's what to some extent impacted our Q3 performance, as Venkat alluded as well, Sakshi. But what we've seen is that all the furloughs that we experienced, most if not all of the people who were impacted by it have moved back into billable assignments and have started work. So we don't expect much of an impact on Q4 from furloughs. In terms of demand, I'll take it both in geo and in industry groups. In terms of geo, even in Q3, we saw India performing quite well. 5 of the 10 logos that we were able to close were in the India market. 3 were in North America and 2 were in Australia. So we continue to see the interest and the opportunities in the India market continue to remain strong. Just the macroeconomic factors in the Indian market, as well as the fact that many of the industries have not started or have not made as much progress on the digitization effort. The North America market, I think we're still watching closely because many of the budgeting decisions which we expected in December have got pushed into Jan, and now some of them are getting into late Jan. And that will give us a clear indication of which way the North America market is going. And as you know, there are some conflicting signals. You have a few parameters that are positive, and then with the Fed announcement in early December, some of the job numbers. At the same time, core inflation continues to be a little bit higher. So customers are playing a little close to the chest. We do have a good pipeline, and our hope is that the budgeting decision will move more towards starting off some of these initiatives or projects, which should translate into business for us. In terms of industry groups, healthcare continues to do well for us. We see quite a lot of opportunities out there. You would see it in the Q3 performance as well. Manufacturing, industrial has been a little muted, more because of furloughs, I feel. But manufacturing is doing well, especially in India. Again, CPG is an industry where customers are continuing to invest in customer experience, analytics, and other space. High tech is still, customers are cautious, and in edtech, higher ed is an area where customers are being cautious, whereas K-12 and workforce development are areas where we are seeing investment.
Okay. Mr. Narayanan, to you now, as far as the margin picture is concerned, there are some dips that we are looking at. What do you think is the key reason? Is that because of perhaps the wage hikes that were rolled out that you see the pressures here? Or do you see that this is likely the band, because looking at the uncertainty in the environment right now, this is where the margins will be in the coming few quarters? What's your outlook there?
So in our industry, we have a few levers. One is obviously the pricing, gross margins, utilization, and the SG&A costs, as we call it. On the utilization front, we had touched 74% last quarter, and we are up to 75 plus percentage. And this has to trend towards a 79% number. So that's something that is there as a lever. At the same time, we have taken all the cost increases. Our wage hikes that happen across 2 quarters, which is Q2 and Q3. 70% of the impact happened in Q2, and the 30% impact hit us in Q3. The typical way we cover up for these increases in cost is through volume increase and rate increase, as we call. The volume increase has been slightly lesser than what we would have typically liked it to be. So, looking forward, volume increase has to happen. Rate increases, we bill at fairly large, good rates. So we're not looking at rate increases, and that sets off quite a few of these increases that we see over on a year-over-year basis, and continue to maintain the margins. So the margins at 24.2% is a decent one. And while you should also see that in the light of the investments that we are currently making. Talking about guidance, we have talked about 22 to 24%. And we are holding on to that, and hopefully for the next year as well. For the medium term, we would like to hold on to that number as a threshold figure.
Okay. Mr. Anantharaju, could you detail for us the order flows? How have they been in Q3, and what is the deal pipeline really looking like for you? Which are the verticals that are attracting the maximum orders at this point in time?
Yeah. So if you look at, from a geo perspective, last quarter, as I mentioned, 5 of the 10 new logos were in India, 3 were in North America, and 2 were in Australia. But if we look at from a industry perspective, I thought it was a little bit better distributed. We had 2 logos from healthcare, 1 logo from retail CPG, 4 logos from manufacturing and industrial, 2 from high tech, and then 1 from edtech. So as you can see, it's uniformly distributed. These are new logos, and in terms of new deals, including existing customers, I would say it was distributed across all the verticals. You see the jump in the BFSI numbers. That was because of a couple of additional projects that we got with one of our large BFSI customer. And and in terms of pipeline, we continue to see a strong pipeline. And as I mentioned, the key is if the budgetary decisions, if these discussions that we're having, if they get funded, I think then we would be able to get started and add revenues to this quarter. The other area where we are seeing a lot of traction is in the GenAI space. And as you know, we created the GenAI business unit, and in Q3 we had around 30 customer conversations, out of which we've had 5 to 7 projects start off. They've all started mostly in terms of consulting and POCs, and we're hoping that next year these will translate into implementation where we will have larger engagements.
Okay. Mr. Narayanan, if you could add to that, I was going to come to Gen AI. So great that you already spoke about that. I think the company already had indicated that over the next 5 years, the company would be targeting a revenue contribution to at least 20% from this segment as well. How is that really panning out? And when it comes to Gen AI, what are the kind of hiring plans that you have? Do you think that you will have to go for external hiring to meet the demand that's generating for you from Gen AI?
Sure. I think we've made a very good start, in terms of GenAI business unit. We've looked at our existing customers to get started with, though we do have a few totally new NN customers that have started with GenAI, with one of them being in the tech space. But with many of our customers, we've initiated discussions on how we can help them optimize or automate their processes using GenAI. And we're looking at both horizontal and vertical use cases. So horizontal use cases would be things like doing queries on your contract, or doing finance, accounting, and other business processes that would be applicable to all verticals. But many of the use cases are vertical specific, and there we have the GenAI business unit working with the industry groups to identify vertical specific use cases where we can develop some demos and take it to customers, which really gets them excited. In terms of capability building, we for specific roles around people with capability on specific AIML models, we are hiring from the market. But by and large, we've moved some of our best people, architects, and business analysts into the Gen AI business unit, because we see this as an engine of growth. And as we had mentioned earlier, the business unit is being led by Rajiv, who's one of our executive board member, and we've had our CTO take over as CEO of this business unit, because we see this as being a techno-commercial space, and they've got off to a good start. We have around 100 people that we've moved into this business unit who got trained on various Gen AI platforms and open source LLMs. And these are the people who are working on both internal initiatives, because we're trying to automate some of our internal processes, and on the customer projects that I talked about. So we see that by and large, we should be able to train our internal people to work on these projects. And the goal is that in FY25, we would get most, if not all, of our people trained on various Gen AI platforms.
Mr. Narayanan, to you now. The other important factor that the company has always indicated is that you are positive as far as the inorganic growth is also concerned. Now, if I remember right, the company's last acquisition was in January of last year, 2023, when you bought Madurai-based IT services for 111 crores. You already have free cash flows of about 9,894 lakh rupees right now. Tell us, for this quarter as of now, and for the 9 months ended, it's 30,323 lakhs of free cash flows, on your books right now. Tell us, what is your thought process when it comes to inorganic opportunities? Are you looking at certain verticals where you can look at some mergers and acquisitions? When do we hear from you on those accounts?
We have cash reserves of about 1,300 plus crores right now, and we are fairly healthy in terms of cash generation. So obviously, we will be deploying that into going through acquisitions and inorganic means, which is what we have been talking to the markets all about. We have a decent pipeline, about 2 to 3 companies where we are in discussion. But acquisitions tend to be binary. It happens, doesn't happen, and it's something that it's not all the time that it's because of us. There are two parties to the deal. Why we would like to close, there could be reasons why they pull out. That said, we are consistently focusing on companies which are digital in nature, aligned to our verticals, working in the India, US, Europe, India access, has a good offshore presence. I'm not talking about India presence, but having a good offshore presence and profitable in nature. So we're not looking for companies to aggregate revenues, which add to us, complement our performance, and are in the digital areas that where we work in. So this is the kind of criteria. While you can call it strict, we are also quite clear that these are the kind of companies that we would like to associate. So wait to
Okay.
hear from us. We'll be able to come and do some good news on that front.
Absolutely. We'll be hearing from you on Business Today television when you break the news for us next time around. And, just we would have loved to do this conversation for a fairly long time, but there is a paucity of time and we're just about 10 days away from the interim budget. So I have to ask you, as a tech player, what are your own expectations from this time around the budget and any wish list that you already have prepared, Mr. Venkatraman?
My wish list is to continue the consistency that we have shown over the last 2 to 3 years, or 3 to 4 years, I would say. Our finance minister has been doing well in maintaining that consistency. Obviously, a lot more clarity could come out, or simplicity could be brought in into the TDS provisions, the capital gains calculation provisions, and I'm sure everybody is asking for that. We are at a point where corporate tax rates are stable, and we hope that it continues to be that, so that there are no sudden changes. Simplification of TDS and the provisions of taxes around capital gains is something that.
Okay, well, on that note, thanks a lot for being with us on this special edition, to both of you, and all the very best for the upcoming quarters. And here's hoping that we will catch up very, very soon to understand more about which way is the company headed, the growth outlook, as well as the industry trends as they are shaping up as well. Good to have you on Business Today television, and here's wishing you a very happy new year that pans out for you.
Thank
Same
you.
to
Thank
you.
you. See you. Thanks. Bye-bye.
Thank you. And with that, we will wrap up this special conversation. Happiest Minds right there. Resilient set of numbers coming in a quarter that's impacted by seasonality and furloughs. There could be some more pain that would drift into Q4 because there is no clear sign of a demand revival as of yet. But things are turning for the better as per the management of Happiest Minds. And by January end is when they will clearly get the idea of what are clients really thinking about spending, about projects, and are they going to be doling out as expected, or is there going to be a slowdown as well? We will continue to tell you all of that. So do stay tuned with us on Business Today television to catch all these interesting conversations with the top managements of the companies that are listed on the stock exchanges.